Welcome to the Investor Talk Show, where serious real estate investors get signal, not spin. I'm your host, Neil Peterson. And if you're buying, holding, or repositioning your portfolio, starting this quarter, the last quarter of 2025, and this session could save you lots of time and money. And joining me is Jaco, Grobbelaar, the CEO and founder of Prosperity Enterprises, well known for turning practical market insight into bankable property moves. Jaco, great to have you on the show.
Thank you very much, Neil. Great to be here.
So let's get straight into it. Let's do a little bit of a cycle check to find out where we are actually really as the South African property market. Which cities, sub-markets are outperforming or lagging right now, and maybe give us the single biggest driver behind each, and maybe just share a measure or something that you could look at which you can confirm those changes.
Great. So what I always love to do, Neil, is to take a step back and look at the property market from a 20 or a 50-year perspective, just to see the big picture. And if you actually do that, you would see that if you take any 20 consecutive years over the last 50 years, property appreciation has been close to 10%. Imagine that, Neil, 10% year-on-year growth on your property. We haven't seen that for the last 15 years. Now, if you take the last 5 years, we probably have seen like a 3% growth in capital appreciation. And that is where I realized that a person has to start looking at returns differently. You can't be so dependent just on capital appreciation. You need to generate a good rental yield, or a net rental yield as we speak in investment terms as well. Now that means your rental income that you earn on an annual basis, your net rental income after expenses that you earn on an annual basis, what percentage of your property's price is that? And to look at that, now what's very, very interesting is, let's take the two biggest cities in South Africa currently. We are sitting with Cape Town and Johannesburg. Now, Cape Town over the last, not just over the last decade, probably over the last 3-4 decades, have shown extreme capital appreciation, very, very good growth, but it has historically had a low net rental yield, whereas Johannesburg has the other extreme, where there's almost no capital appreciation, and but there can be very good net rental yield. Now, when you look at your returns, or when you look at the cycles of property, you need to look at both of these returns. You need to consider the capital appreciation and the net rental yield that the property is generating for you. I told you a scary stat the other day, Neil, and that was that a scary piece of information is that I bought a property the other day in Sunninghill, in the northern suburbs of Joburg, and I paid less for it than what I paid 10 years ago for a property in that same complex. And in 10 years, we've literally seen zero capital appreciation. So from a lagging perspective, Gauteng, and especially Joburg, has especially had it hard the last decade. And we can see that also in the poor service delivery and the quality of the city that has just gone backwards. And I don't see those things actually as problems. I see those things as opportunity, because today I'm buying property in Joburg more affordably than what I've ever bought property in Joburg. So I actually see it as an opportunity for a good time to buy. So speaking of specific cities, as you are asking, Neil, and cycles, I think Joburg is as close to the bottom as you can get. And I think that makes it a great opportunity, to actually invest now. We've got local elections coming up next year, and there's some very interesting things happening in the political space in Johannesburg right now. Some very interesting announcements that are being made, and I think that there's a lot of opportunity for things to change in the near future in Johannesburg, and one must obviously consider that political factor as well, as that can have a massive impact on the actual returns that a city's properties can generate for you. So I'm keeping my eye on Johannesburg. I live in Johannesburg, and this is where all my properties are. So I'm keeping a very close eye on Johannesburg. The Western Cape has always shown very good capital appreciation, and I don't think that is going to stop anytime soon. On international terms, property in the Western Cape is still dirt cheap. And I think we will probably continue to see decent growth in the Western Cape. So if you want to invest for capital appreciation, I think you are safe to invest in the Western Cape. The only challenge of the Western Cape is of course, the net rental yields that are significantly lower. In Gauteng, you need to be creative. You need to generate your returns out of your cash flow, out of your net rental yield. And that's very, very important to keep in mind.
Great. I think that's nicely put. And so let's talk a little bit about the inflation squeeze and obviously rate relief, because we're now in a cycle where we're going to see interest rates going to a downward cycle. I mean, currently the prime lending rate is sitting at 10.5%, dropping, but yet rates, taxes, compliance, other services, they just keep rising. And 80% of listings, according to a very recent estate agent survey, says that all those 80% of properties are overpriced. So how should investors actually price and buy now?
That's actually scary to think, Neil. So I mean, we all know in the last 10 to 15 years, property prices have actually appreciated very little. And yet inflation is running high. I mean, anybody would agree with me. If you look at your rates and taxes the last decade, if you look at your levies, if you have a sectional title property over the last decades, those expenses are increasing far above inflation. Whereas up until recently, rental incomes have not. Rentals have stayed flat. Now, a couple of years ago, I just decided, well, I'm just going to start pushing up my rentals and see what happens. And surprisingly, most of my tenants have stayed. So I think a person must also be, I mean, we are in a better market now where we can increase rent a little bit more. But we also need to be intentional to push up our rent. And I understand you stand the risk of losing a good tenant when you are pushing up the rent, but you also need to be consistent with that. Is every year you have to push up your rent a little bit. And I think in the current market, it is also possible to do that.
Okay, great. So let's talk about the opportunities versus the hype. I mean, where are serious investors putting money today? Let's talk about some of the categories. I mean, is it buy-to-let? Is it student accommodation, multi-occupancy, short-term rentals, holiday lets, maybe small mixed use or something else? Which ones are the ones?
One thing that I am telling my investors and my clients is that we need to get more creative in the way that we invest in property. The traditional buy-to-let model is dead. It might be resuscitated in the future. We don't know. It might come alive again. But as things are now, buying a property and putting a long-term tenant in there, the returns are just not competitive. So you have to think out of the box. You have to think or look differently at this and see where the opportunities are. Now, I categorize the opportunities in 4 categories where I really see big opportunities. There are obviously more, but these are my 4 main ones. And that is number 1, multi-lets, where you have multiple tenants on a property. Number 2 is student accommodation. I mean, there's a lot of hype around student accommodation as well. And a lot of people are going into student accommodation, but there's still great opportunities in that space as well. Then short-term rentals, Airbnbs, and then lastly, low-cost housing. Those are the 4 categories for me where I really see massive opportunities in the future. Now, each of these 4 categories is like a sport of its own. It's like the one is rugby and the other one is soccer. So you are going to have to learn the rules of the game for that specific type of investment because they look entirely different. Even though all of them are in property, it's completely different games with a completely different set of rules and completely different set of risks because each of these strategies, as great as they are, And as much opportunity as there is, has big risks that you need to consider and mitigate and hedge as well.
Okay, great. So is there one particular investment category that you're avoiding right now?
The only category that I'm avoiding right now and that I won't touch is what everybody's doing, and that is a traditional buy to let. That's the traditional buy a property, put a tenant long-term in, and subsidize the shortfall out of your pocket. That I have stopped doing. Now, I'm not saying that you can't build wealth and that you can't get a decent return by doing that. But what I see currently is that this strategy does not work anymore. We don't have the appreciation anymore. It might come back. We never know. Property might start aggressively growing again like it has done previously in the early 2000s, in the 80s, etc. Things go in cycles. So you could have that again. But I've decided, Neil, that I'm not going to bet on the economy anymore. I'm not going to wait till the economy performs for my investments to perform. I decided that I'm going to prosper irrespective of what happens to the economy, irrespective of who the government is, and irrespective of what happens to the property market. And the way that we've done that is by thinking more creatively in how we are going to rent out our properties and how we are going to position ourselves to actually maximize the rental income that we can generate out of a property.
Excellent. Nicely put. Let's do a little bit of a financing reality check. How are deals getting funded in 2025? I mean, there's banks, there's private alternative lenders. There's more options than there was before. So, I mean, typical loan to value ranges you're seeing and debt service credit ratios you underwrite to make a deal bankable. Maybe you want to share just some of those. What are typical loan to value ranges and sort of the debt service credit ratio to make this deal really bankable?
So I don't know if you saw the stats, Neil, but 50% of properties being bought are bought cash. So there's a lot of money sitting with apologies. There's a lot of people sitting with a lot of cash.
Absolutely.
And a lot of people are investing cash wise, but I am still buying property, financing it through the bank in my entities, in my companies with the trust holding the shares in the companies. I'm still getting 100% financing every time. Well, not every time, but many of the times that I buy a property. Sometimes for whichever reason, I don't get 100% loan, then I get a 90% loan. But is it still possible to get 100% financing when you buy property? The answer is absolutely yes. Does it have to be in your own name? The answer is absolutely no. You can buy property in an entity and get 100% financing. I think that's a very, very important thing to take note of. Banks are also hungry for business, Neil. I mean, their business, they are in the business of lending. That is what banks do. So I always tell my clients and my investors, don't be too sentimental or too loyal to a specific bank because banks also go through cycles. Some of them are overexposed, some of them are underexposed, and some of them are more aggressive in their lending strategies. Others are more conservative currently. So I always use a bond originator. I always apply at all the banks and see who are the banks that have appetite to give me financing. And then I go with the bank that gets me the best deal. So bank financing is still by far your most common financing that you can get.
Okay, excellent. So let's talk about pre-deal foundations that you should implement. Things like trusts, companies, special purpose vehicles. What structures do you insist on and why? From a tax, also risk ring fencing, succession planning, etc.
There are 4 pillars to structuring, and you've just mentioned them now, Neil, that I think are critical when it comes to building your property portfolio. And that is number 1, asset protection. Number 2, estate planning. Number 3, financing capability. And number 4, tax benefits. Those are the 4 pillars that I see as the 4 pillars of structuring. And you need to have a structure in place that can give you those 4 benefits. Give you the asset protection you need, number 1. Give you the estate planning benefits that you need one day when you pass away. That gives you financing capability, the ability to scale, the ability to build a big portfolio. And number 4, give you the best tax benefits. And the way that we structure our clients' entities is we set up a company for them, a property company that acquires the properties for them. And then we set up a holdings trust to hold the shares in those companies so that the ownership of the companies don't sit in your own name. And we've seen that this structure works very, very well to build and scale and protect and have a tax-efficient property portfolio. We also administer these entities for our clients, so we take care of the financial statements, the tax returns, all of those things. A lot of people are scared and say it's expensive. It's actually really affordable if you set your structures up correctly and you use the correct service providers.
Excellent. So let's talk a little bit about tenant risk. And I would say for some people it's from absolute chaos initially if they don't manage their tenant properly, to a situation of good cash flow. So what are your non-negotiables for vetting, for leases, deposits, collections, escalations? And maybe just share how you manage arrears and evictions without burning months of income, because there's a lot of investors that fall into that trap.
Great. So there's a couple of things that I think a person needs to keep in mind. The first thing that I really encourage you to do is that you run your property portfolio like a business. So have good software in place. There's a lot of software out there that you can use, that you can manage your tenants with. In other words, do your billing, check your arrears, send your letter of demand, send your cancellation when it's applicable, all of those things. So get good software. The days of running your property portfolio on a piece of Excel in the day and age that we are living, those days are gone. There is phenomenal software that can automate and simplify the process so much. So one of the first things that I want to say after structuring is get good software to manage your property portfolio with. And then once you get that software, use it. Get comfortable with it. It can take you a while to learn the ins and the outs of the software, but most of the software are quite user-friendly. So get comfortable with it and start using it. And then the key to tenant management is always vetting. Make sure that you vet your tenants well. Now, there's 3 things for me that I like to check, 3 or 4. The first one is check the income. Rule of thumb is that they should earn 3 times the rental income, the rental that they need to pay. So check their income. Confirm that on a salary slip and confirm that on their bank statements. So that is very, very important. That's the first thing, is check the income. The second thing is check their credit score. Now, behavior is very interesting. Most people that are bad payers all over. And most people that are good payers all over. So if you have somebody that diligently pays his clothing account every single month and his car by installment, that person is probably going to pay their rent diligently as well. On the other hand, if you've got someone that every now and or every second month miss their car payment or their clothing accounts are in arrears, there's a good chance that they're going to pay you badly as well. So credit check is a non-negotiable. Do a credit check and check what the condition of the prospective tenant is that you want to put in your property. And then lastly, and very importantly, get landlord references. At least the previous and the previous landlord and the landlord before that. Get their references to find out how was this tenant as a tenant. From a vetting perspective, that is very, very important. And then lastly, Neil, I think it's very important that you've got and this sounds a bit harsh, I don't want to make it sound harsh, but have a 0 tolerance for late payment policy, meaning that you immediately start communicating with the tenant when they pay you late, and that you issue a letter of demand from an attorney as quickly as possible after the first of the month to show the tenants that you don't tolerate late payments and that you keep your tenants up to date or that you ensure that they stay up to date rather with their rental amounts outstanding.
Excellent. I think there's some really good advice there. So let's talk about value add that works. I mean, earlier on you mentioned creativity in the deal, and so maybe talk about some of the value adds like subdividing a property, converting a property, sectionalizing it, putting in multiple tenants, maybe students, light renovations, putting in maybe some solar energy. So maybe share what are the ones that move the rental needle now?
The most important thing is that you know what your strategy is going to be, because and it's okay to dabble in different strategies when you are starting out because you are finding your niche. But I personally think if you really want to become successful, the quicker you can find your niche and start specializing in that, the better. Now, if you, for example, want to invest in student accommodation, the first thing that you need to do is you need to buy properties near universities. It doesn't help you buy a property in four ways, but Wits and UJ is sitting on the other side of Johannesburg. So you need to buy close to your tertiary educational institutions if you want to invest in student accommodation. With student accommodation, what works very well is houses, big old houses that you can convert into many rooms. That's a great strategy. I always, with a multi-let strategy, if that is the route that you are going, I always encourage my clients and investors to look for properties that have additional units that you can rent out. A property with a cottage at the back is perfect. If it has two cottages at the back, even better. Then you've got things that you can do. You can convert the main property to be two units. You can convert the garage that the garage becomes a bachelor's flat, but you can easily convert a property that has two tenants or that can take two tenants to a property that can take four tenants. The moment that you do that, you are in the pound seats. I can almost guarantee you're going to have an excellent investment there. Obviously, you need to check the zoning requirements with that. You don't want to get into trouble with the municipality. So that is a challenge or something that you need to look at in that space. When we look at the short-term rental space or the Airbnb space, you obviously want to invest in cities where there's a demand for short-term rental, right? You want to position yourself in a place where there's opportunity in that regard. You want to be modern. You want to have good quality furnishing in the property. So those are things to look at. And then in the low-cost housing, blocks of flats are often a great opportunity if you buy it right. If the returns are good, where you can buy an entire block of flats in a more low cost housing space, and where you rent those units out.
Excellent. Good. Some really good ideas there. So let's talk about big mistakes that investors are making now in 2025 in particular. Maybe share, one error that rookie investors keep on making, and maybe share one which let's call them the more seasoned and you could say portfolio proud investors and the mistakes that they're making. And sometimes they confuse that scale with returns, and it doesn't always happen that way. And maybe just share, a quick fix for each, because at the end of the day, it's not just about the mistakes; it's about how we can fix, and maybe giving some practical advice on that.
Absolutely. So I think the biggest rookie mistake that amateur or beginner investors make is they buy property in their own name. And that is luckily something that can be fixed quite easily. Sometimes it does cost a bit of money. It's also something that we assist our clients with, is to restructure your property portfolio into the right structure. That would be one rookie mistake that beginner investors make. And another one is they get so excited to buy property that they'll pay any price for a property, and they end up paying too much for a property. You cannot go wrong if you buy your property below market value, because if you buy it below market value, it means you can sell it again at any time and get all your money back. So when you buy a property, buy it at a discount. Make sure that there are enough motivated sellers out there for you to buy a property below market value. You don't have to buy a property at a premium. You don't have to buy a property new necessarily. You don't have to buy a property and pay market price. There's plenty of opportunity to buy a property below market value. I think for the more experienced property investors, I think a lot of them don't run their portfolios like businesses, so they don't have proper systems and automations in place. So they reach a place where they maybe have 10 properties, but it's almost like a full-time job because they're all over the show and they don't have structure. So I think that systems and automations is a mistake that the more experienced investors are making, and also buying property that doesn't cash flow, that they are subsidizing out of their pockets. They are fortunate because they have enough money in their pocket to subsidize the property, but you never know what happens in the future. You could lose your job, your income could change, and suddenly you don't have the cash to subsidize your shortfalls on your portfolio anymore. And if you are looking at a portfolio of properties, that shortfall can very quickly become a very big amount. So to avoid that, be intentional to move to a place where your properties cash flow, where you have positive cash flow on your properties.
Excellent. Great. Finally, we got about 90 days, because I think, and I call it the 90-day sort of plan to invest before the end of the year. So we want to keep our investors busy here. So maybe give us 2 tracks, one for the first-time buyer and one for the seasoned investor. Maybe to do that 30, 60, 90 plan, and maybe what actions, targets, funding, offers, etc. they should be doing, activities. And then, of course, for the more seasoned investor.
Great. So first thing for the amateur investors, a goal that you can set for yourself is get your structures in place. I think that's very important because when the opportunity comes, you don't want to run around putting your structures in place. So you can set up a goal for yourself to say, this year I'm going to get my trust set up and my company set up, and for the next number of decades, I'm going to use that structure to build my property portfolio. You could put your structures up and get the first offer to purchase approved still within this year. However, if you are a beginner investor or you are thinking of investing in property, I want to encourage you to invest in yourself first. Educate yourself. You can set a goal for yourself to attend an investors evening or a property investment seminar this year, something that can educate you to read a number of books and never stop reading. I calculated the other day, I'm standing on over 150 books now, Neil, that I've read over the last 15 years on property and business. And I'm not stopping. And you never know enough. You can always educate yourself more. You can always learn more. So a goal for a beginner investor is definitely to educate yourself, invest in yourself, and to get your structures in place. That's probably the best investment that you can make for this year still. For the more professional investor, for that one that has a portfolio already, I always say this on the investor evenings, but consistency is key. It's not about how much you do this year. It's about how much you do every single year. It's about consistently, little by little, adding and adding and adding to your property portfolio until you eventually sit with a property empire. And that consistency, nothing can beat that. If you can consistently work towards your goal, that's a great place to be. I set a very specific goal for myself as a professional investor. I try and buy 1 property a month, and it's very easy for me to track where I'm at. So it's September now, that's 9 months in. Have I bought 9 properties this year? And that's how I track it. So if you want to build your portfolio aggressively, you can do something like that, where you can say to yourself, I've got 3 months left. Let's see if I can get 1 property purchased or at least OTP approved for every month coming. So there's different ways that you can measure it depending on where you are in your journey. But wherever you are, be consistent and take small steps forward. It's not necessary to take big leaps. Just take small steps forward consistently as a professional investor. And you're going to be further than 99.9% of investors out there.
Excellent. Jaco, great insights, sharp as always. Thank you. And I mean, we covered cycle realities, funding truths, and a practical 30 to 60 to 90-day plan. So if you're watching this, for those of you, I would suggest watch the replay again. of this particular video, and because there've been really some good insights given there from Jaco. Jaco, there's also an investor evening coming up soon in Johannesburg in October. So maybe you want to share with the audience the details of this particular investor evening coming up.
Maybe I'm a little biased, but this is definitely the event of the year to attend. It's the 23rd of October. It's in Johannesburg. It's at the Radisson Blue Hotel in Sandton. It's a black tie event. So you and the person that you bring can dress up. Men can dress up in tuxedos or in black suits. The ladies can get their evening dresses out. It's going to be a phenomenal event of networking. We're expecting over 200 people the evening there. It's going to be a great opportunity to network. And then we've got phenomenal speakers. We've got 10 speakers the evening speaking there. Neil has got a phenomenal talk that he's doing at that event, the 23rd of October. And then we've got key industry leaders that are speaking there as well. So if you want to know how you can take your property portfolio to the next level, or how you can start building your property portfolio, you do not want to miss out on this event.
Excellent. So what we'll do is we'll drop the link below in this video. And so there will be a link to actually book for that event. And as Jaco said, please come and join us. It really is a networking and property event of note that you just cannot miss before the end of this year. Once again, Jaco Grobbelaar, thank you very much for your time. It was great chatting to you. To our audience, if you have not clicked subscribe yet, just click subscribe to the Investor Talk Show and also our weekly brief on rei.co.za.